These questions are made for you to be able to have an empowering conversation so you can double check that you're perfectly aligned and you're with the right financial advisor. After all five of these questions, you may learn I'm with the perfect person. This is great. This just reconfirms and strengthens my confidence in the fact that I'm with the right financial advisor. The idea is the choices are up to you. I want to empower you with the questions and with the knowledge, and you can couple that with your own goals and experience and risk tolerance and time horizon, and you can set sail to tailor and have the best wealth creation and preservation blueprint as possible. The best one possible.
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Sylvis, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. Get ready for empowering conversations, expert insights, and real-life stories that inspire you to live abundantly. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
Secrets to Abundant Living podcast community. Hello. Welcome back to another solo episode. I am your host, Amy Sylvis, for those who don't know me, and I am the founder and CEO of Sylvis Capital, a real estate private equity firm that connects investors to hands-off real estate investment opportunities, particularly those in the commercial sector like apartments and flex industrial. So, it's been a minute, my friends. It's been a minute since we recorded a solo episode. I've been doing quite a bit of traveling, speaking of abundance and creating more abundance in our lives. I've been to Dallas twice. I was in Seattle seeing some friends. So all sorts of fun stuff. And I can't believe we are just knocking on the door of college football starting back up again. 'Tis the season. I'm so excited. I hope you all are too, if you're a college football fan. If you're not a college football fan, let's make you one. It's a lot of fun and it brings a lot of abundance to us, right? For those who don't remember or need a refresher, we define abundance by being able to do what we want, when we want, where we want, with who we want, for however long we want. And very often that freedom and that ability to do that is dependent on us having hands-off income. And so how do we create hands-off income if that's a goal of yours? Not saying it should be, but it's definitely impacted my life in a very positive way. Lots of ways, right? We can invest in stocks that have dividends. We can invest in bonds that clip coupon, that give us distributions. There are lots of ways. We can have intellectual property that we own and we can get, what are those called? Residuals. That's what I'm looking for. Residuals from books, right? Income from books and digital assets. And of course, one that I've chosen for myself, just one of several streams of income, which is commercial real estate. So I have a few things I want to talk to you all about today. It's going to be a pretty quick episode, but I'm hoping to talk to you a little bit about financial advisors, which we've talked about here on the podcast before, but I think it's worth talking about. And then this idea of diversification. So first and foremost, many of you may have financial advisors, which is fantastic. Y'all are busy working your jobs, spending time with your children, and having hobbies of your own, giving back to the community, all those great things. So you may not necessarily have time to study personal finance as much as you'd like, and maybe your financial advisors fill in that gap for you there. I created actually on LinkedIn a piece recently to help you understand if your financial advisor is on your side. So we'll put that link in the show notes, but yeah, financial advisors can be great, but we also have to understand that they may not be aligned with our goals and our risk tolerance and our time horizon. So we always preach here on the podcast that one of the best investments you can make is really a education on your own personal finance. I think a lot of us are made to feel that we're not capable or we don't have the time or the knowledge or the background to be able to understand all of this. But Gosh, empowering yourself and investing even just a little bit of time can be quite incredible, especially because it allows you to, for example, evaluate your financial planner. So let's talk just very briefly about a couple of questions, a few questions that you can ask your financial advisor to see if they are aligned with you. The first thing I want you to consider is asking your financial planner how they are compensated. And again, I'm not saying that this is good, bad, up, down, left, right. It is a data point that you can consider. So, how is your financial advisor compensated? Are you paying a flat fee to your advisor and they're providing that service to you? And there isn't anything further that's happening? Or instead, is your financial advisor earning commission based on what he or she recommends to you? As you can imagine, even though financial advisors have a fiduciary duty, of course, to do what's in your best interest, we find, and as you can imagine, I talk to a lot of people, we find that some financial advisors will only recommend financial instruments and investments that they can make money off of. And let me tell you, there are some asset classes that are alternative that we talk about here: direct oil and gas investment, private lending, obviously private equity, where you invest in businesses that aren't necessarily listed in stock exchanges, and direct ownership of real estate, like what we do at Sylvis Capital, and gold and silver bullion. The financial advisors don't always have the ability to make money off of those investments. So I'm not saying yours, I'm not saying all financial advisors, but there can be, as per human nature, a relationship between how some folks make money and what investments they recommend. So again, I'm not saying you should invest in those investments. I'm not saying they're right for you. I never give financial advice. We give education here about what's possible, what's available, and then, of course, how to evaluate the folks that are giving you advice. So considering how your financial advisor is compensated might be a data point that's helpful for you as you continue your own self-education in the financial space on personal finance. And then, of course, as you seek advisors, seek information. So, yeah, a lot of folks I talk to don't even realize that there's such thing as a flat fee financial advisor where you just pay a fee for their advice, and their folks don't necessarily make commission off of what they recommend. They make money off of the fees that you pay. So that is the first question I would encourage you to ask. Not telling you how you should react to the answer to that question, but if you haven't asked that question or you don't understand how your advisor is compensated, that might be a good thing to find out. And then, of course, the natural progression from there is question two, which is, hey, do you receive incentives? Do you receive commission based on some products that you recommend? So really being direct, drilling down, because, hey, this is your financial future, man. Got a little casual there, but hey, man, this is your financial future. This is your nest egg. This may be your legacy for your children or your impact when you give to charity, your impact on your community. So it's important for you to be direct and really understand what's going on. So saying, hey, Mr. or Mrs. Financial Advisor, do you receive these incentives for specific companies, specific products? Let's understand what's happening there. And that will give you a more clear picture on what might be going on there. So that's number two. Number three is asking how the financial advisor will tailor advice to your personal goals, risk tolerance, and time horizons. So we would hope, and we'll give them the benefit of the doubt, that our financial advisor won't have a one size fits all, but rather will take into account your age, your risk tolerance, your goals, the legacy that you want to leave, your lifestyle, all of those things, and make personal recommendations there. So asking them how they will tailor that, or how have they been tailoring that, instead of just a depersonalized one size fits all. Hopefully that's not happening, but it's a good thing to ask. And then asking, hey, how do you define diversification? I think this is a fascinating conversation, right? So if you remember diversification, the goal there is to invest in assets that don't perform in sync with each other. They're not correlated. So meaning, hey, if I invest in oil and gas and I invest in real estate, is their performance historically aligned? Do they both always go up at the same time? Or Sometimes does real estate go up and oil goes down, and then there's the reverse. Oil goes up and real estate goes down. That's correlation. That's diversification. So having a conversation with your financial advisor to understand, how do they define diversification? What does that mean? Because I'll tell you, again, not financial advice. I am just giving education and talking about myself. I used to once believe, and I used to work with financial professionals that believed, oh, we can find diversification in mutual funds and stocks. And guess what? Small cap, large cap, foreign, overseas, outside of the US, NASDAQ, S&P 500, Russell 5000, dividends, growth stocks, value stocks. Hey, that provides diversification. I will tell you, if you look at the data, not my opinion, but if you look at the data, paper assets are correlated. Full stop. Yes, there may be slight deviations amongst different asset or amongst different types of stocks, but the stock market is correlated with itself. If you are invested in, let's just say hypothetically, you have a portfolio of 100% paper assets, they're all correlated with each other. So let's say they all go up at the same time. That's great. But what if they all go down at the same time? My goal for myself, not saying it should be for you, is to have assets that don't necessarily go up and down together. So if I need to draw upon, sell, take distributions from certain asset classes unexpectedly or in a planned way, I'm not stuck in some cycle where, oh gosh, my portfolio was way up a few years ago and now it's tanked because everything is performing in a correlated way, right? I hope you're tracking there, but I think this is a really important concept. I was quite stunned once I realized this misinformation, as I would classify it. Again, I'm just looking at data. This isn't my opinion. I'm not saying you should invest in anything. But for me, having assets that don't perform together means diversification means that there is more of a less volatile performance of my entire portfolio. So this is where this really hits home for me. A lot of folks have their wealth in their retirement account. Ideally, we have wealth in our retirement account outside various asset classes, in my humble opinion, for me, not saying what you should do. Retirement accounts have mandatory distributions. Y'all know that, right? So you have required minimum distributions in your retirement accounts, like an IRA, 401k, at age 73, if you were born between 1951 and 1959, age 75 if you were born 1960 or later. What if your mandatory distribution happens when the stock market's down and you're invested in all stocks? Dude, think about it. Let me share my screen here. This is what keeps me up at night. I don't know what that says about me, but this is why I'm so passionate about diversification. Hopefully you can see this here. Okay. So this is the S&P 500. I think this goes back to, 85. So let's say you turned 73 and you were born, I don't know, in 51, and you had a mandatory distribution, minimum mandatory distribution starting in February of 2003. So the S&P 500 was down 30%, somewhere around there from its peak in, let's just call it June of 2000 down to February of 2003. That's almost 3 years. It took a while for the market to recover. In fact, it looks like it took until 2007. That's 7 years. Y'all, that is 7 years that it took to go back to where it was before. What does this mean? So you have mandatory distributions all throughout here if you're over age 73. The idea is, for me, not telling you what to do, but I want to invest in assets that are down right here and are up right here so that this line ends up being more steady Eddie, and I'm not a victim to having to take money out of the stock market, out of my oil and gas investments, selling my gold and silver bullion. Do you see what I'm saying? I'm not victim to these dips. Rather, things are a bit more smooth because I'm in different assets. So if I get sick, if I need to help my family, I find a really great charity that I want to donate to that really God has really called me to contribute to, or I have a mandatory distribution from my retirement account. I'm not victim to these falls. So we go again. Look here. We were in, let's see, September 2007. Then there was another dip, right? We remember the global financial crisis, maybe hit a nadir in February 2009. How long did it take to get back up here? 2012, dude, 2007 to 2012, that's another 5 years. So what if you're having to take mandatory distributions here and you don't have 5 years to keep your money in the market to have it recover? So hopefully you're seeing what I'm saying. Again, I'm not telling you what to do. I'm simply giving you education and illustration on why diversification can be so powerful and asking your financial advisor what diversification means to them. You may agree with them and you may say, hey, Amy, I want to be just in stocks. Totally fine. I am not trying to convince you otherwise, but I'm helping you understand my perspective and maybe a different way as you go through your personal finance education. Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show. All right, so we are asking our financial planner what diversification means to them so you can have those conversations there. What else should you talk to your financial advisor about? I ask them what assets they invest in personally. Do they have experience in some of the asset classes that they're recommending to you, some of the investments that they're recommending to you? Totally fine if they don't, but on my end, again, not a recommendation to you, but on my end, I'd love to invest alongside somebody or get advice from somebody that's on the same track as me, that's helping me where I can get, take advantage of their experience. And if they haven't invested in something that they're recommending to me, why not? Hey, the answer may be you're more risk averse, I'm more risky, and this just doesn't fit. There's nothing wrong with that. These questions are made for you to be able to have an empowering conversation so you can double check that you're perfectly aligned and you're with the right financial advisor. After all 5 of these questions, you may learn, I'm with the perfect person. This is great. This just reconfirms and strengthens my confidence in the fact that I'm with the right financial advisor. Or you may say, oh, well, hey, maybe we're not aligned. Maybe this person only makes their money on commission and that doesn't sit right with me. Or maybe this person's recommending a bunch of stuff and they don't invest in it themselves. The idea is the choices are up to you. I want to empower you with the questions and with the knowledge, and you can couple that with your own goals and experience and risk tolerance and time horizon, and you can set sail to tailor and have the best wealth creation and preservation blueprint as possible. The best one possible. So I am really passionate. I recently had a conversation with a financial advisor who said, stocks always perform the best. I have heard real estate goes up and down and that's it. And I thought, interesting. The conversation actually came from, you may have read this, that Trump is talking about maybe allowing or encouraging some 401k custodians to allow people to invest outside of the stock market, outside of the traditional stocks, bonds, and mutual funds. Now, yes, you can do that already in your self-directed IRA accounts, but you can't create self-directed IRA accounts usually from 401k plans where you're currently employed. So Trump's idea, not saying I like it or not, just saying this is happening, but Trump's idea is for your existing employer to allow you to invest in different asset classes in your 401k and this financial advisor was all up in arms, and I suspect it's because he might lose some money because he's not making money when people invest in crypto or real estate or private lending or private equity or gold or silver, bullion. Oops. So, hey, there are conflicts of interest. I want to make sure you know what they may or may not be, and no financial advice. You can just decide what feels best for you. Okay, this is a quick episode, y'all. I'm going to ask you a quick favor. Send this episode, if you found it helpful, to a friend. Please. The podcast is growing. We invest a tremendous amount of time and effort and money into producing this. You all get to consume it. And a great way to support the podcast and to support me is to share the knowledge. I'm sure you understand the concept of just how rewarding it is to teach and give and inspire and help people along their journey. I bet every one of you does that in some capacity, and this is one of my ways to give back. So would love to get your help in helping me give back and spreading education and information that might be helpful to folks. Well, thank you so much. I look forward to the next episode, and it's almost football season, y'all. I can't wait. USC's unranked. It's fine. I'm just grateful that the season is back. And do I say it? I think the Trojans will perform well this year. We'll see. We'll see if I regret saying that. Bye, Dawn. I'll talk to you all soon. Bye for now.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.